Okay, I think I got it. So, anywho, let's kick this sucker off. I think the biggest thing today is kind of like, since we had this downside move, and the plan was when I scheduled this thing, was the fact that we were in this kind of crab range, for scalping and whatnot. So I guess the big thing here also is that we're going to start looking at structure as part of a bigger idea of understanding scalping and lower time frames. Essentially, when we look at things like this on the weekly, and we look at like what's happening, what's it testing, essentially, you have a much easier understanding of like, oh wait, we're failing the this structure here, we're failing it back into the range. Oh, what about the downside? Have we tested all the stuff we're supposed to test? Right? Have we tested everything here? No. There's still a lot of stuff left to test below us if we continue breaking down. So that's kind of the big thing to look at, is that if you can understand the high time frame trading, which it's so much easier to trade high time frame, the low time frame is no different. The problem is that a lot of the stuff low time frame, there's a lot of questions of liquidity and liquidations and market basically moving much quicker because your aspect is essentially a tunnel vision. So from looking at the weekly, where you have 7 days, 24 hours a day, right? It's a lot of hours. Looking at the daily, you're looking at a 24-hour time period. Looking at the 4-hour, now we're down like some intraday type stuff that can potentially happen. And when you start getting down here on things like the 15-minute and even lower, which we'll look at a little bit lower, the thing that really messes most people up most of the time is that they don't account for essentially the quickness of some of these moves, and that hey, I can make 7% potentially, until we fail, right? In some of these trades, comparatively to the higher time frame, where it's like, well, maybe I'll make 20%, but it might, or 20 or 30%, but it might take me 3-4 weeks to a month. So the hardest thing to do with this thing, and we'll do that as well, is talk about the risk reward, the trade planning stuff. But overall, starting on the scalping, I'll kind of just run you guys through what I do. Even on the 15-minute, it's great to use things such as like the crypto flow index and the Harmony oscillator, just because you see a lot of correlation between deviation when we have price continue moving up, and then we have a new high, then we have a bearish deviation, and the trend is already breaking down. Trend and strength have essentially led the move, saying, hey, by the way, we're breaking down. What else has happened? Crypto flow index, if we look at, as an example, the stablecoin large caps, I'll tick these off. What I've done, and I think it was it yours, Alarin, the idea of using the lines instead of the blocks? But the idea is that you can now, instead of having the step line, which is a little less clean, it's a little jankier, the line looks kind of cleaner, but with the step line, you can actually see the breakdown as it starts, essentially. So we'll go through that as well. The big thing that I'm kind of looking for overall, if I just take this and then tick off altcoins and shitcoins, since I'm looking at Bitcoin specifically, right? You see a lot of correlation with this stuff. So there's a lot of things that you can use tool-wise that really help you. I'll go through that, and then we'll talk about the swings and the tests and structure and whatnot. So with the oscillator, no difference. I just use this with the bearish divergence on regular bearish divergences because it does give us so much good data. And then essentially you get a bearish divergence on your local time frame. You're looking for a failure at a major level, which we had for a short lower. And there's a couple other ways to kind of like anticipate the move. With the flow as well, you're seeing stablecoin essentially going, the price is going up, stablecoin starting to go up as well, and then continuing to leg up as we break down. Another great indicator. Same thing as with the large caps, right? Large caps are breaking down. We're moving back to the downside in the local structure. So those two things I look at. Another thing I glance at, like lower time frame, it's not as important, but funding rate. Again, we have price moving up and we have funding rate coming essentially back to neutral or more neutral. So what does that tell you? That longs are not being as incentivized. You've got breakdown of Harmony oscillator. You've got the flow showing stablecoin gaining levels. Essentially, you have 3 or 4 different things already saying, hey, this upside move is unsustainable. It's coming to an end. And this is something you can do on the higher time frame as well. But even here on the 15-minute, we can then use that to look lower time frame. So with core trend, as an example, you will use this and just turn off. You can use core trend for the bands along with the MDVD. which I think is really great. So I usually have the liquidity grabs on. I have it set on scalp mode. Doesn't matter about the filter stuff. And the big thing here is to make sure that you've turned off the different types of bar color type. So if you have bar color type off, you can then use the MDVD with it. And then also with the bands, they're extremely powerful when you actually see breakdowns. So now, again, the idea with this is that you have multiple layers of confluence that show you changes in the overall price and structure. So I'll let that load up real quick. And then we'll use that as we look at some of the different scalping levels as well. But right off the bat, we'll kind of look at, what we did back in these highs, essentially breaking down levels, grabbing levels to go higher. What we're actually seeing essentially is failure that goes lower. I'll just keep the bands off for now. But generally speaking, the bands are pretty powerful in the 15-minute if you're looking for little quick moves, or if you're trying to catch the bigger failures. Again, what do you have? You have a breakout, you have an upside that closes back below previous highs, you have failure of that level and range, essentially at 3 a.m. my time, which is 1 a.m. UTC, it was done, right? Failed the range high, failed the low, we had a bearish divergence confirmed, we had gaining stable coin, large caps essentially running flat and losing, a lot of different levels showing on reversal points. So I'll just turn the bands off for now just so you can see it. But essentially, this is what you look for, right? The yellow dots there, that's ticking on a core trend. The liquidity grabs, those are, again, a great potential for upside. They're a little less accurate because they fire more frequently on the low time frames and the high time frames, but it's still, again, a useful tool. So with this, I don't know how you guys feel about the MDVD, but this has become a very core part of what I've been doing. I'm not actually having to split screen and watch order flow as much. I can kind of focus on volume. And a lot of times you'll actually get some really good entries. There will be points where it fails. Nothing is 100%. But probability-wise, you have a lot of potential trade setups just from this. So looking at the high structure, and we'll kind of use this as a template to kind of look at what we've done and where we're going from like a perspective of swings, because it's important on the 15-minute as well, right? So what's some of the most interesting structure that we've created? From the high, essentially we had the level that we gained that took us to the high, right? This is when I start drawing the green lines and I don't label them. I'm talking about swings, I'm talking about range gains, stuff like that. So instantly, what was it here? What was it here? And what was it there? It was resistance. It was resistance. Became support, was flipped at the loss of level at the same time. Failure, by the time you hit a new low, you're essentially now failing to make new lows overall. And that's something that we look for as far as like the breaks. This is why when we do the normal streams, we talk about gaining and losing. This is a loss, right? We've lost the level that we gained that took us to the high, bearishly retested it, down, new low created. When we create a new low over the previous structure, what do we look for? Secondary failures. So that's all it is over and over and over again. And it seems sometimes a little bit, over, it's a bit much sometimes, but it literally is that easy. So we'll kind of use that as far as like targeting reversals. So going back a little bit to what we talked about on the last Fireside, we talked about swings and swing structure. So what's some interesting structure that we've created as far as like in the local stuff, right? We have a high that's created here, a little bit out of position. It's a bit hard to kind of adjust and use this candle on its own. But what do we know that this candle is doing? Well, look to the left, right? This thing is essentially coming up and testing the previous highs that we did. It's still essentially a major level. And if we even look further back, again, a bigger level overall as far as like flipping it. And it's not going to be perfect. Like it very rarely is going to be perfect, but it gives us a good perspective of like where we are in the overall movement of the price. So what we've done now, right? We've got a couple different points that we can use. Looking at the scalping stuff in lower time frame, where are we looking for step offs for continuation? Well, if the local high isn't giving us a lot of levels, let's use the next block essentially, right? If that's the high we created, what's the interesting stuff? We've got this level here, right? Is that respected to the left? Yeah, pretty nicely, right? We've got some confluence of level. We've got some confluence of level going even further to the left. But this is some interesting structure at the very least. To the downside with the current low we created, right? That's already been tested and done. And that's where we're fighting for right now, as essentially to hold it. If we start losing that, that's a continuation down, right? But what else do we see? There was support there. It was quite low on the Harmony oscillator. There was a high stable coin that broke down, essentially. This thing will lead a little bit, so I'll switch this to the cross so you can see it. But where the price is essentially here, stable coin's already breaking down. By the next candle, it's broken down further as we're gaining and making new levels. And then what do you want to see? Local back test for continuation move up. And these little scalp moves, I mean, you put 1, 2, 3% away, a day, or maybe you do your target's like something like 10% on a week or something like that. That stuff stacks. It goes higher and higher. So this is essentially what we're doing now in the overall structure. We're looking at this from that kind of perspective of, testing everything back correctly. And I'm on the index now because I don't know what exchange. I know a lot of guys are using different exchanges, but overall, when you're doing your TA, you want to be making sure that your TA is on whatever you're trading on. Ideally, you're using the highest volume ticker that you're trading on, but at the end of the day, if you're not happy with it, some good alternatives would be using stuff like the BitMEX perpetuals. If you're trading perpetual futures, that's a great chart to use. I love BitMEX perpetual futures, and even BitMEX itself, I'm actually considering going back to it because it's what we use to short most of our stuff because they have great things for shorting as far as the funding rates and whatnot. But so even here, right, we've got some interesting levels. Let's go down further. I never myself go down to the 1 minute really anymore, but on the 3, you can use quite a bit of structure on some of these levels. Is this still a pretty respected level? Does it still play out pretty decently on an index? Yeah, pretty decent, right? What are we doing? We're breaking down. We're holding some structure. What's the important stuff that we don't want to lose? It's all this block down to the downside here. So that, come back up to the 15 real fast, check it. Does that kind of play out a little bit? It's not as, it's still in the kind of like zone of where you don't want to see continued failure. But even down here on the 3 minute, you can still scalp, you can still do stuff, having multiple points of confluence, essentially, you're breaking up, start seeing the yellow dots, right? What do you wait for with the yellow dots? Break down a level. You get a trend change at the upside, right? The trend change happened the moment it broke down and lost the level. What does that mean? So even on the 15 minute, this is now essentially your major level that you don't want to see gains above. Do we have any gains above it? Even on the index, no. We closed above, bearish retest, closed below, continuation. Secondary failure, third failure. Everything's failing the thing to the left of it, right? That's good. That's clean price action. Everything's failing and failing off of previous levels. We create new lows. We broke some of the structure that we gained that took us to the local high. We failed it. Secondary failure, new low, pop up. Did we gain anything back? No. Continuation. So now we're down at this level here. What's our next priority? Well, we're breaking down some structure on like the 15 minute. If you want to change, one thing that a friend of mine mentioned that he uses quite effectively, let's say if you're looking to plot on both the current structure you're on, the current time frame, and then also I would call it, a level above. So if I'm on the 3 minute, I still want to have an idea of what's happening price action wise on the 15, right? One thing that he recommended, and I really like it, is you change the colors of some of your lines essentially. So if that's the 15 minute one, which is going to be more important than the 3 minute, you can make it a darker or brighter version of your green or your red or whatever works for you. So what do we do here on the 3 minute? Do we break down? We close below? Do we break the level? Do we break any structure? No, we dipped down, fully tested it. We're now bouncing back up. So now you wait for the next close. What do you want to see happen in the next close? Well, you probably want to see some reaction here above you. And this is how you can start scalping low time frame. So if you do see failure there, you can try and short it with a very tight stop. And if that fails, you can try to short it at 26.66, whatever that is. And if it gains this high, what is it doing now? If it gains above that level, it's gaining a new high. So essentially, you break that local high, you potentially change the local trend. Even if you come back down, now you're looking for a higher low, right? We had the continuation down. We're still holding levels. We're down here in like the 3 minute. If we can hold this structure, we can talk about a potential move back up. The easiest ways to play these scalp levels is essentially looking for things that retest on levels perfectly, and then things that regain levels that you've lost, right? So if you regain the level you lost, it's a pretty important level. We're getting down here to the lows, right? If this comes all the way down to it, this is the low that you want to see a hold on to some degree. This is still holding the low swing currently, but it's all dependent on essentially where the candle closes. And this is why the closes of candles is more important than the wicks. Yeah, the wicks will still kind of dictate where you're going to see support and resistance, but where the candle closes will tell you if you're back testing something bullishly for a potential bounce, or if you're essentially a continuation of the move. Right now, what are we doing? Well, we're breaking down. From the high, failed twice, created new lows, lost levels, and now we're down at the current low that's in place. There's nothing that says that we have to go back on the upside until we actually regain the structure at 26,729. And that's because this here is the range that we lost that led us to the local low. Right? Does that make sense? And now what are we looking at above us? We want to see holds of this low swing to gain back, to go higher, to at least retest it. And these might seem inconsequential as far as like the amount of the moves, but you get a bullish back test of something you lost, right? What do you look for? You're looking for something that makes the juice worth the squeeze. What do we know if we go back up to this level from essentially where we want to enter? Well, what happens at 0.75%? 100Xs are liquidated. The cheat sheet there, and that's what we use our liquidations based off of, is percentages based of leverage liquidity. That's how liquidations works. So a little cheat sheet there is 100Xs. Let me type it in so you guys can see it. Now we'll just do 20 versus 20x. Roundabout. It's not going to be perfect, but that gives us ballpark. And the reason these things are important as far as moves is that a lot of times this will go from liquidity to liquidity, right? So if we lose the low of this range, essentially, how do we liquidate the levels? Are we getting down here to the point where we're losing, all of the 100Xs and some of the 50Xs? Yes. What if we take it from the mid of the range? This is a little bit more accurate when we're talking about ranges and retesting. If this is a range, the upside that we can kind of say, yeah, that's definitely a range, we look for around about the middle. Doesn't have to be perfect to come back down. What have we done? We've taken out we've taken out the 50Xs in this zone, right? So we want to see now, essentially, we've tapped the level almost to the dot, like within a couple cents of it. So this here will potentially show dictate that we're going to reverse if we gain something back. And there you go. Let's see if we can get it for the close. We got another minute on it. But essentially, this is what you look at. You target major levels, and you keep your stops tight. Because if you get stopped out, there's nothing that invalidates the trade for a long until you lose the low. If you lose the low, right, the only thing then that you can make a long argument for is you have to regain the level to at least retest levels that you've lost. And then we can use some confluence tools, right? We've got our oscillator on, which is great. We've got some turnaround right now. We're seeing with the low, or the very low time frame with the crypto flow index, and we're gaining back levels and we're testing stuff perfectly. Like, this is why swings work in a sense. Seeing some yellow dots, we're very oversold in the current time frame. Having some nice bounce structure, some nice continuation moves. Essentially. Essentially testing stuff, which is good. But with this as well, and I'll kind of use this, I'll turn that off for a second just to kind of reiterate some of the trade planning and whatnot. So when you find these levels, especially if you have stuff that gives you the swing automatically plotted by auto charting tools, what you're looking for essentially is that's your level, and you want a 3-to-1 to your first profit target. And that's going to blow, that's probably going to mess a lot of people up, because they usually look for things like, oh, I want the long from here, right? But where do I target? Where's my next, am I going to target all the way to the high of the range there, right? Where's my stop loss? Well, essentially, if you make a new low, right, and this is why people put their stop losses at the tops and bottoms of wicks, is because they say, well, if we make a new low, it's still trending to the downside. Well, what if it, essentially during the candle comes back down and retests lower and then goes like this? Well, they've been stopped out, right, because they grabbed the liquidity, but then you've regained the level that you want to see, essentially doing what we call an under over, where we go under the level, come back up and bullishly retest it to go higher. So what you actually do is that, or at least what I do, is that I never want to be the one liquidated and then having to fight with the millions of other dollars or however many contracts are that have their stop losses at the lows of wicks. Because if you don't know in the order book, let's say your orders, has a value of $100, right? 100 contracts. You don't know if those 100 contracts are first in line to get out. You don't know if there's maybe, $10 million worth of, is that 10 million? No, there you go. One more zero. You don't know if there's $10 million of contracts that are already have their stop losses, their exits in front of you. And what you never want to, this is why when people say, I put my stop loss here, but it got me out down here instead of here. That's why. It's because other orders were action first. It's a first come, first serve type thing. So how do we beat that? We tighten up our stops, and we aim more realistic with our essentially our first profit targets, right? So where would our first profit target really be? At the level you want to see gained. Where are we seeing resistance? Exactly where we're supposed to. So can we have the continuation? Absolutely. But is something like this very high risk reward? Does that meet the criteria for a first profit target and a high risk reward ratio? Yes, it meets all of those things. Now, a lot of times you might get skipped. You might get on the level. You might want to front run it a little bit. I wouldn't, if you're trading a really low time frame, it's going to be pretty tight. So I'd probably make the argument that you want to front run a level a little bit, just slightly, so you don't get skipped, and then make sure you're not getting stopped out. That's the way I trade. And then where am I targeting? I'm targeting the next level above. That's important, especially for continuation, right? So what do we have now? We pop back up to the major level. First profit target hit. Stop loss now goes from being out of profit, where you want it now, at the current low. Because what do we do? In the last 9 minutes, we essentially said, well, here's the low currently. Here's that swing. That's the high of the swing, because it's price coming down. And now we've got that there. That's already been back tested. So we lose that, then we look to come back down again. It should be up priority until we lose 26.5. If we lose 26.5, we want to come back down to test the high of the swing. And then again, the highest probabilities for longs and whatnot are what? If price is coming down, you're testing the low of the swing and the high of the swing. What do we know about probability? Probability says that if you test the low of the swing, there's a higher probability that it'll go up. Comparatively, that if it comes back down to the high of the swing, there's a less of a probability. So even here, right, we've back tested it bullishly. We've gone up and broken the level a little bit. We're still fighting for it. If we do end up failing back down, what does that now give us? It gives us another local long, a local high that we can kind of look at. So, and this is how you flip between your low time frame trades. And if you're hitting these high risk reward ratios, you can lose most of your trades. And that's the whole point with the trade planning, is that if you have your high risk reward ratios on your positions, you are looking essentially to take multiple trades, get stopped out, lose more trades than you win, and you'll still be able to make profit, which is like the dream. You don't have to be good at trading, essentially. You can just keep losing trades. You can't win, you can't lose all of them. You have to win some, But if your risk reward is 5.3, I can lose the trade 4 times and still make profit. What you don't want to get into is, essentially, well, this, right? I lose the trade once. Then the next thing, all I can do is essentially just make my money back. And that's why we target high risk reward trades. That's the whole point. Any questions? I'll kind of open it up there for a second. Everyone just mind blown? Or does that make sense? Like, I'd love to hear some comments on what you guys think, essentially. Yeah, but that, I agree, and that's the hardest thing. The hardest thing is the mentality. The TA like this, you can learn in a day. Well, not a day, but probably a couple of weeks. But the mentality of essentially just saying, you know what, I'm going to take those trades as long as they're going in my direction, right? I'm going to keep taking the trades, and I'm not afraid of getting stopped out. Most people have a fear of it, and a lot of people actually get psychologically messed up from loss. That's a big problem for most people. They essentially, they've lost money or they've been taken out of positions, and now they can't essentially bring themselves to trade emotionless. And the best way that I would say, if you're trying to get into the scalping stuff with the low time frames, because yes, the most money you can make is essentially taking leverage, increasing leverage, that type of thing, to get more bang for your buck at these zones. The way to do it, the most effective way to do it, is to risk as little capital as possible in your trades and keep doing the scalps and trying to win it. I don't recommend paper trading because that's no risk. If you're not trading with any risk, you're not learning and you're not getting better. You only learn price action, you only get better at price action by actually trading. And that's a big thing that a lot of people think, oh, I can just watch a video and be good at it. You got to actually do it. And that's the hard thing. So with that mentality, like I said, lower your risk, lower your exposure to your account to as low as you can possibly go, and then start trading some of these scalp zones. But if you're not already making money, say on the 1 hour or the 4 hour, if that's still blowing you up, you need to focus on the higher time frames first. It's less fun, it's less sexy, but at the same time, it's the important stuff. If that makes sense. But most people, like I said, the fear is mostly it's almost entirely based off of the fact that you've lost money, or if you've taken a couple trades and you continue to lose your trades, essentially, right? And that's the hardest thing that is for most people. Any questions on that? And you're not alone, Alarin. You're not alone at all. Another one of these swing things. All right. So in the local structure, what have we done? I'll get rid of these. Had the breakdown, the 15-minute loss that led us lower, right? Close below. We got the bounce back up for a nice little scalp. We're closing back down below into some major levels, or not major levels or lower time frame levels, but essentially we're at the levels we don't want to see lost, essentially. We fully tested this. We're now closing underneath the current stuff. What matters, essentially, if we're going and closing underneath, we need a gain right here to go higher, to come tap back up and test the new structure at the upside, right? And that's where we are now, right? We've closed down below. We haven't bearishly back tested it. You're looking for now, you close below it, but you still need the bearish back test to continue the downside, right? We close below, bearish back test is what keeps us going lower. Otherwise, what can you expect? Potential bounce. You got a little bit of the move. Let's see if you can get the lot of it. What's the important level to kind of break the trend of the downside? Essentially, it's the gain again that goes here. That's the major gain locally in the low time frame that takes you back to test structure higher. If you don't get the gain, then it's still continuation of the downside. And this is why, waiting for the close is like one of the most nerve-wracking things, because now you've closed under the level, you're back testing some stuff locally in the little structure here to potentially go lower. So you can continue targeting lower, but you're also getting into the low of the local range, right? You don't want to short at a potential breakout. That's never a good idea, because essentially, what are we doing using some of the tools we have? Well, we're at the level to hold. It can still go down further. We want to see a gain back to go higher. So what does that tell you? It tells you that if you don't gain the stuff back, you're going to keep going down until proven otherwise. There you go. You've broken that structure. Watch the close. If the close closes back above, regain some structure, regain some levels, you get a bounce back to the upside. So what do you look at now? You've lost levels. Are you looking for an entry? No. You're looking for an entry once we gain back above, because now we've created new lows again. So close back above, gain some levels to go higher. That's the big thing essentially that we look for in these low time frames, right? But I like the 3 minute myself. I don't like the 1 minute. I think the 1 minute, it still plays. You can still do it on the 1 minute. And a lot of times they're very respective of the same levels, 3 minute to 1 minute. For me, it's such a low time frame that it's almost like painful. Plus, you'll get a lot of deviations and divergences. All right, new low created overall. How do we invalidate the low? You have to gain something back to go higher. Broken all the liquidity is taken out from whatever low that was in. The move to the downside from some of the structure we had above. Where are we at? Yeah, so all the 50Xs are taken out, even from the low of that range. Yeah, about all the 50Xs are taken out. You're getting some bounce now. What do you want to see? Watch the close. You want to see the close that takes you back in the range to go higher. You're back above the low of this local structure. So good chance for a potential bounce as long as you don't close it below. Again, think of it this way. Like, this is the easiest way to think of this. It's a deviation because it only closed underneath. It didn't bearishly backtest it. Like, if it had gone that, closed, and if this candle here had just gone there, you'd have a pretty high probability set up for a continuation down. Now, it can still go down. Like, it's all probability based, right? But and we've made new lows. So what's essentially, what are you looking for when you're looking for a trade in this zone? You want to see something gain back that gives you a better essential test on structure, right? We close back below, close back within the range, nuke back below. Again, you're looking for some type of form of structure. My big thing is looking at that, just because the gain there is what takes you back up to test this and potentially higher. Until then, you're making new lows. You've closed back above, but you've made new lows. The priorities hasn't changed from down. The rejection at the high, we caught the little bounce move. Great, move back to the downside. What now invalidates the downside? Essentially gaining back the level that you lost. Right? We had a gain of this structure here, gain to go higher. Here was the failure that led us to lower. That's the main level in my head as far as like going back to the upside. Like, even here, you made a new low. So are we getting close to potential reversal? Yes. Can the 3 minute stay super, super, super oversold for a long time? Yes. So how do you know it's actually the level? You have to gain something back. That's the only thing that's important. If you don't gain anything back, it doesn't matter what it does. That's like the hard part about the low time frames, because you'll see a lot of deviations as well. And that blows most people get blown up by it. And even like core trend, it's a little bit too tight in this zone. It's the only time you look at failures is like, you have a high, you have a failure at some levels, secondary failure, you're looking to short the level for a breakdown until you lose it. So even here, you had a bit of liquidity grab in the previous candle. Nothing's confirmed, essentially, until you gain back the levels. Can we do anything off the delta? Yeah, there's still some heavy volume below us. Again, this is the 3 minute. I think the delta's the best on like 15 minute and 1 hour. As far as using that just as like a volume tool, essentially. So here, it's almost entirely swings. You're looking for entirely change of structure, change in everything. Do we see anything that's telling us that price is starting to move up? Not yet. Stablecoin flow is still up. You know, large caps are still kind of down. We're not really getting a good read of the level. We want to see closes back above to go higher. Until we do that, we're essentially just making new lows. This is important structure that we've made now. We've broken down, made another new low. So we want to see some gain back to go higher, some close above to go higher. Yeah. 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 Yeah, that's the easiest way to do it. Like, yeah, yeah, yes. I will on the lower on the lower time frames, as again, especially with things that are less liquid. Like, let me see if I can find a more liquid chart for this, because there's a lot of overlap where it'll close and then bounce immediately. Because you're on a very very low time frame. So let me see if I can find maybe a perpetual is going to be higher liquidity. Um, Well, volume deviations are a thing. They absolutely are. But the problem is that volume. It can still pump on low volume. It can still dump on low volume or high volume in the current like low time frame. So the problem with volume at low time frames is that you don't have a clear read of where stuff is supposed to go because it's such a low time frame. That's the problem. If that makes sense. Like volume for me, I like deviations in volume on like the 1 hour and and higher, because low time frame. If you have high volume and price goes down, your first thought is, well, people may be shorting. Well, how do you know? Well, you don't. People might be taking profits or getting stopped out of positions. That's kind of like the whole not understanding it. Um, the problem is that if you're only looking at volume, I like volume deviations or increases in volume before with price. Let's say volume's going up, but price is staying in this zone. That's good. That means that there's something happening essentially. But again, it's higher time frame, especially on like when I look at micro caps and like small caps and stuff and the shit coins. I essentially want to see volume spikes before a move on a higher time frame. But I mean, the volume is the amount that's being traded. So like, if you're looking just at the like, if you're looking at just the volume by itself, it doesn't really tell you much. But if you have like the historical ability to see, like, if I just swack on volume, is it going to tell me a lot at the low time frame? It depends on the ticker, because it's pulling data from the ticker. So like, we have a low, we have high volume dumps, we have high volume up that goes into a flat with low volume. We dump with higher volume. Volume is still technically higher than it was here on the current structure, but we're still failing at levels. What does that tell me? Essentially, at the low time frames, it's a little bit irrelevant. But if we can use our normal price action stuff, which is, here's a great stepping stone as a level. Why? That was essentially the level that took us to the high in the local zone. It was the range. It was the floor. It's now being bearishly backtested. You can make arguments for higher levels above us, but that's essentially the higher time frame version of what's going on in the overall ticker. So as long as we're holding this low, that's the important block. What are we doing with that block? Are we testing stuff? Yes. Have we tested it bullishly? Yes. Where are we in the overall structure? Well, if this is a range above us, this is essentially where we are now, is a range. If we start losing that level, essentially breaking back below June, losing the 13785, then we start getting into a kind of a danger zone effectively. So until we break that high, this is where you start seeing the overlap that gives you quite a bit of like structure. So right here, as an example, you're failing essentially what was the level that you lost that took you to the low, comparatively to gaining the level back to come back up and test the highs. So what matters now is the overall structure. What's in this low here, what matters? The June level. It's coinciding with the downside structure that matters. We want to see holds there if you want to go back to the upside. Otherwise, it's priority down because we've already broken down under the major structure. It's much easier to try and long a regain than it is to long at the low until you've gained something back, if that makes sense. Because what's the priority? The priority is down. How do we invalidate the downside priority? You gain back the level that you lost, which is essentially this, that led you to the local low. And that's what you're just doing over and over and over again. But again, with the 3 minute, you get tunnel vision. Does that level play out in the 15? Yeah, it still plays. It's not wonderful, but it still plays. What's some important structure here, right? We've got that level on the 15. I'll change the color so we can see it on the lower on the time different time frames. And on the upside, I mean, you essentially have everything failed above you, which you can't even retest. So it's irrelevant, really. Looking at the lower time frame, yeah, that's where you're seeing the hold currently. This is kind of your little spot if you want to see holds. If you see losses of this stuff, it's just losses of higher time frame levels. But what has it done already? From the low we put in, we've already bullshit back tested it, right? What else are we seeing? Flow's starting to break down a little bit with the stable coin. Nothing's locked in yet. What do you want to see a gain of? We'll see a gain that goes higher to come test structure. Once we lose that low, it's a continuation potential until proven otherwise. But we're still holding it. That's the important structure, essentially. But it's a time-based thing. That's the hardest thing in this whole spiel is it's all a time-based thing, right? Failure, you create a new low. You've overall in the structure, I mean, like on Bitcoin is a great example, right? You create a new low, you've lost structure, you're bearishly backtesting the level. How do you invalidate that? You get a nice close that essentially gains back above to go higher. Until then, where's the priority? Has it changed? No. It's failed a 15-minute level. It's failed, couldn't even retest anything lower time frame. It kept failing below that, nuked off a cliff after making lower highs, failure to regain. And now essentially it's under everything that's important. If I want it to turn around, what do I want to wait for? I want to see a gain that goes higher. Gaining back within, gaining back some floor structure. Again, it's all based off your risk reward. But it looks like it's finally doing it a little bit here. We want to see that gain back and not the failure. But most people try to do that. They their risk reward, they target their risk reward to some magical number way, way above what it should be, essentially. So what you end up getting then is that you get a risk reward that's absolutely wild instead of something that's just targeting local structure. Even here, it's like if we gain that back, I'm not super keen on taking a trade, even on the gain back, risk reward wise, until we essentially do this. Price goes up, gains above, and then you're looking to hold the local structure, and it can still stop you out right away. But again, 3-to-1, 4-to-1, the higher the risk reward, the more chances you'll have essentially to re-enter the trade until it's invalidated. And it's only invalidated when you make new lows and you lose the local structure. So now what you've done, you've gained back within the zone. You want to see an upside continuation. You could just essentially try and long it as a continuation. If it fails and goes lower again, you might get stopped out once. But essentially now you're gaining back within after going to the downside. What did this downside move do? You can just check it. Took out all the 100x's that were trying to long the structure here to go higher. But that's most of the market. It just swings. It goes liquidity to liquidity. Oh, people are still trying to long it. Well, it'll probably keep going down then. Any questions on stuff? Because I know it's still a weird concept for most people. It's still, even for me, sometimes I'll have to sit down and go through a bunch of notes and just kind of like refresh myself, clear some of my trading charts out. Yeah, I'm recording it. Yeah. So, and also it's like people try to realize why this is happening. Like why is price doing this? And the essential thing is that it's price will always try and test supply and demand. Price is always trying to figure out, are we going to go higher? Are we going to go lower? Are there enough people? Essentially, it's worth a 5-minute Google if you don't understand the term supply and demand, because there's a supply and demand, diagram essentially. So, are there enough people buying at this price? Enough people who want to buy it, and not enough people selling at that price. What happens then to price if there's more people trying to buy than there are people trying to sell at this price? Price will go up to meet, the demand will meet the supply. What happens if there's not enough? What about here? Why did we go down? Well, essentially, there's too many people selling at this price and not enough people wanting to buy. So what do people who are trying to sell do? The price has to go down. Essentially, they have to be willing to sell because there's not enough people buying. Nobody wants to buy at that level, so price goes down to meet supply, goes down to meet demand, essentially. So, and that's all it is over and over again. That's an oversimplification because markets are essentially inefficient, and markets have other factors that affect it. And this is why I trade crypto mostly, is because there's a lot of other data you can pull, which is, you can pull on-chain data. You can look at live retail stablecoin demand. Right, this is a great tool, especially when we have divergences. Right, retail stablecoin demand, like this is one of my favorite things for just scalping. If I'm only looking at crypto, I'll put the retail stablecoin demand on regular divergences, and I'll invert the chart. Right, so what do we see? We have lows created. We have breakdown on flow, increase on flow for what we're looking at, which is Bitcoin, a large cap, and we have essentially a divergence. And that's the entire thing over and over and over again. So there we go. I mean, didn't you get it? Close above, bullish backtest the entry, long, first profit target hit, stop loss and profit, and on and on and on. Does that make sense? Well, yeah. So yeah, that's absolutely right. I keep it. What I'll do is I'll move my stop and profit at this point, just because I want to de-risk my account, like my capital exposure. I've taken my profit target 1. I've already locked in. Usually when I'm scalping low time frames, I'm very aggressive, so I take like 20, 30, 40%, and with these, you can also fully exit your trades. That's not something that's wrong for me, because the amount I'm trading with, it's nice if we actually gain some levels, and some of these low time frame trades will sometimes turn into high time frame gains that come back up. Maybe we'll come back up to like 26.6 or something like that. Right? Look at that. We got a 15-minute bull div as well, potentially with this. We'll watch the close and see what happens. But the lower the time frame, it's less likely to play out. But at the same time, if it goes against me and we start losing the level again, I can still continue to try and take the trade to try and catch it. But if I'm hitting this consistently, which, it's a pretty decent zone for me. I've had 2 in a row that look really well. So, and if it comes back against me, that's not the end of the world. That's why people who will even like take a profit target and not move their stop loss. So what happens is they'll still end up going neutral on the trade that was essentially a winner, because they're too greedy. A lot of times, and Will's really good at this, he'll just GG out. Like he'll scalp more than I do with higher leverage on low time frames, and he'll just like, yep, I got my whatever the percentage move, got almost 50%. All the 100x shorts essentially liquidated from the entry. Bam, GG, done. Move to the next trade and the next trade. But if you can do that consistently over and over again, that 0.4, 0.5%. Even with 10x lever, that's a 5% gain on your capital. If that makes sense. So so the way I usually do it essentially is that, you know, even if this trade's invalidated, right? I basically look at it like this: is if price comes back down to this level to re-enter, is it still valid as a trade? Yes, I would say. No, like so if I take the trade and it hits and then it goes back against me, my first, yeah, so then because we're trading on low time frames, you can try to do that, but here's the problem: if you try to do it exactly the same entry, it's already been tested. Like this, yeah. So that's the problem that I have with it, is if it's already been tested. Yeah. Well, it's more or less not even jumping the gun. It's that, you know, price action has occurred. Like new structure has been created now since that trade. Does that make sense? Oh, this one. Well, on a re-entry on this now, I would probably wait. Like, that's my whole thing. If this thing fails now and goes back below my potential entry. Okay, yeah. So hypothetically, it went back down to this, right? It went back down here. What's relevant now in the local price action, since it's already done what I wanted it to do? Like, that's the problem with you know, re-entering at low time frames. Like, if the trade would have stopped out, like let's say it would have done this, price, instead of doing that, it would have come right back down, tested that swing, and then gone back up and then re-entered. It would have stopped me out, right? That is essentially saying, well, the trade, this long is invalid until we do this. That's the way I look at it, is that if it had stopped me out right away, come back down to test structure, what do I want to see now? I want to see a gain back above. Then the trade's still valid if we do that. But if we create new lows, it invalidates the trade entirely, the long entirely, because now you have more price action. Yeah. So the hardest thing to do, I think, is to differentiate between, you know, a trade getting stopped out or going against you, and a trade and your trade plan being invalidated. So essentially, if you're looking for longs in some of these zones, hey, we're really, really oversold. You know, we're coming back up to test structure and levels. You know, we're looking for the little bounce play, the little, you know, 0.5%, the little, you know, you swack on some good leverage on there. Again, you can make high percentage moves just in these really small, low time frames. The problem that most people have is that, you know, as soon as one trade goes against them, it's like, oh, it came here and it stopped me out, and then it goes back up and they don't re-enter. The problem is that you're absolutely able to re-enter, but if a lot of times people get frustrated because price it'll come back down, stop you out, and then it'll just go and do what it's supposed to do. So what do? People panic, they FOMO in, essentially smashing a market entry, and now price is, you know, essentially going to go against you again. So my conditions for hitting a trade like this is essentially like, it has to do what my plan is entirely. And the plan is only valid as long as we do two things. A, we don't create a new low because I'm looking for a long. Same thing as if I'm looking for a short, we don't create a new high. And B, we actually do the test I was looking for. The actual perfect bullish back test of the level to go higher, right? Unless those conditions are met, like, I just don't do it. I skip to the next thing and the next thing, if that makes sense. Yeah. Oh, I know exactly how frustrating it is. Trust me. I've been. so here he. Well, that's. And that's the whole thing. That's the emotional mentality of like getting stopped out and how it like fucks with people's brains. Is that when you get stopped out because it just goes just barely against you, and then it does what it's supposed to do. Yeah. So what happens? Did it do your plan? It just stopped you out the first time. Is the trade still valid? Yes, the trade is still valid. This is why you do high risk reward ratio trades, because I can get stopped out on this sucker 3 times and still make profit. 4 times now, because it's a risk reward of 5. Right? And that's the entire point. If your trade plan is like this, doing a risk reward of 3 or higher, like preferably higher, because we're targeting to our first major profit target. What are we doing now? We closed above, bullishly back tested. It should continue. What if it doesn't? Then it collapses back in and loses levels. The whole point is that the idea that you need to win most people don't win most of their trades. You know, I win most of my trades now after like years and years and years and thousands of hours, and like that's the only way I got to it, was essentially the mentality of taking these trades with extremely low exposure. Like I'm talking, you know, I would do this for hours with like less than $1, like the least amount of money possible in expose myself to the markets. And then once I program my brainwashed myself to basically not give a shit about if I'm making profit or if I'm taking losses. And then I stop caring about it. And then all I do when I take positions, I don't say like, okay, what dollar value does my trade have? No, what percentage of my total account am I? This is another trick. Like people focus on the dollar, because if you lose $10 in a trade, you know, what's your first mentality? It's like, shit, I could have bought some food, I could have bought milk and some eggs and some bread and some other shit. Like, you know, those little thoughts in your brain fuck people up, and they do. But that's the entire market psychology, essentially, in a nutshell, which is you need to stop caring about losing profits, losing money, and like making profit. And the only way you do that is by programming yourself to have no emotional connection to it. If you're getting frustrated and you're like, oh, fuck this is all, TA's all a scam, blah, 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 blah. Like I've watched the YouTube videos of like, I don't know, one of the funniest ones was like a 50-year-old dude. He's like, I've been a professional trader for 20 years and I can tell you TA's a scam. And it's like, okay, great. Well, how come it works? How come it's repeatable and consistent? Like those guys never got that. And most people don't. Most people don't have the ability to find repeatable and consistent structures when they actually trade. And that's the problem. And people who don't essentially train their own brain to think like this, which is, I don't give a shit if it goes up or down. I've still got a risk reward ratio that's high enough to where I can lose the trade more times than I win it. I can lose most of my trades and still make profit if I'm, planning my trades correctly. And like I used to have these things as post-it notes. Like Will's been telling me I need to start making these as like a, like we need to sell like the post-it note pads, but I think that's kind of dumb. Essentially, it's just rules of stuff that are important for me. Like I used to have them everywhere, so I ingrained in my head. It's like risk reward equals 3 or higher, right? 2% max capital exposure, which means, where I'm essentially, how much of my account am I willing to have at risk at any time? 2%, right? Depending, and that's in my capital. That's not counting leverage. Leverage increases everything, obviously, but 2% total max capital exposure of my money, not what I'm using in leverage, but my money. And then how do I reduce, take planned trade to first profit target. What's another one? Stop loss and profit as soon as possible. This reduces your capital risk to 0. Right? And that's the whole point. That's what people mostly don't do. They don't reduce the capital risk to 0. They don't move their stop loss up. They're afraid to take profit because the little lizard part of our brains says, "Ooh, I'm super greedy. Ooh, I'm super fearful." And that's most people. That's like 99% of people are like that. I mean, there's a reason why the best traders are kind of like have antisocial personality disorders and stuff like that. I mean, really, some of the guys we know, it's like, I wouldn't hang out with them. You know what I mean? I wouldn't let them around my kids, but they know what the hell they're doing. But that's a lot of these guys are cold, calculating, emotionless guys, and I mean, you got to understand how you get that way. Like looking at the cycle of Bitcoin where we're in now, in crypto, in the markets in general, right? There's not new money coming in. What does that mean? We're playing a zero-sum game. You making profit means other people are losing money. It's not like it's the bull run where there's new money coming in, and you essentially have. I love the pie chart example, right? The pie chart, which is like this, my little sliver of the pie, that's mine. But if in the bull market, the pie keeps growing because more people are coming in, right? But eventually, when it tops out, we hit the bear market, what happens to the pie? The pie shrinks, and so does most people's slice. And that's the whole thing to think of, because we're in essentially a transitory period between now and the next halving, and regardless of how the stock market's doing, it's still a pretty sketchy thing that we have 5% interest rates. From 2 years ago, we had 0, right? Or 2.5 years ago. So that entire thing there on its head, like on its like face value, essentially is saying, well, I'm taking money from someone else because they're losing and making bad trades. Yeah. So you can make money in spot, but you can't make money in derivatives, is what you're saying. And in spot, you essentially you keep averaging in because it plays into your dollar cost averaging perspective. I mean, yeah. The big thing there, it's like I had this issue back in 2020 because we had been in the bear market for so many years that I was literally, to try and take long positions, I was having to invert the chart to be able to take trades. As one thing, which is kind of a weird one, because my brain was stuck on short scalping everything. Just short everything, scalp everything down. And we were just on BitMEX, This, yeah. No, so like it depends on the time frame, but if like as an example, like if Bitcoin and ETH are going up, I'm not looking to short alts. You know what I mean? That's what I mean by that. It's like I will sometimes have opposing essential positions depending on the market, and like everything looks different based off of price action, right? But generally speaking, if Bitcoin and Ethereum, which represent 2/3 of the entire crypto market by dominance, if they're going up, everything's probably going up. And it's easier for me to then, not have to trade the outliers. Like I don't often trade outliers, mostly because they're deviating from the rest of the market. So that's what I mean by, if everything's going up, I'm only looking for longs. If everything's going down, I'm only looking for shorts. It's only because essentially I'm kind of like using that as like to increase my probability of my trade. Well, if everything's going up and everyone new money's coming in, we're entering in after the happening and the bull cycle starting, I'm only going to be looking for longs and accumulating spot until we have a major break of structure. But the outliers for trading, like everyone does this, and it's really, and it's kind of crap essentially, is they look at these percentage changes on the chart, and then their first thought is, well, BNB's down blah 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 amount, so I'm going to look for a long. That's the mentality that messes people up. I look at these percentages down or percentages that are low compared to other things as ways to say, well, they have, if Bitcoin and ETH are going up and this thing is running flat or it's still down, what's my first thought? Well, maybe if it holds price and structure, BNB is probably not the best example because of the whole Binance FUD, but in general, it means that things that haven't moved or are trading opposite that have the ability to then do the move that haven't done the move, so to speak, those things I'm interested in because they just simply they're not outliers so much as they're haven't moved yet, essentially. So that's why I usually trade alts. Like if Bitcoin and Ether are moving up, and then I look at some alts, hey, alts are starting to move, but not this one. Why? And then I investigate and try to figure out why it's not moving. What is something missed out? Oh, it hasn't gained its major level. So I just put an alert and say, hey, well, what if it regains its major level? Oh, then I'm looking for a long. Like if everything's green and one thing is like minus 10%, I'm not going to be like, oh, I'm buying that. Like that's not my first mentality. Like the percentages up and down is just to see essentially the deviation from everything else. Like what's lying out. BNB. Does this look really attractive right now as a potential position? Probably freaking not. The only thing that we can potentially say is, well, if we start gaining structure back, what are we going to get because of how badly it's been performing? We'll see a bullish divergence. But until that happens, like we need other information. What's happened? What's essentially what? Go ahead. Yeah. That's the FOMO. That's the greedy part. That's like, oh, I magically know something different because this is going down and everything else is going up. It's like, well, what's actually happening? Well, BNB, the pump that it recovered from the BNB, first of all, it was a very small recovery. It didn't regain the floor of its move on the 4-hour. It's broken down. It's lost its Q4s, several major monthly levels, the monthly support and resistance. And where is it at now in the higher time frame? Right? You're essentially back testing high structure from the lows it did in December. What matters as far as like potentially regaining some levels, regaining some structure? You gain something back. So what would I like? Let's say I want to look for a BNB long. What would tickle my fancy, so to speak? Well, if we're testing this here, we're testing essentially the low structure that we did on that flip, essentially, right? Bullish back test of the previous range high, continuation of the upside. We're testing it now. We're testing it bullishly? Yeah, for the time being. We got a lot of hours left on the daily. Does that 4-hour give you a lot of confidence right now? No, probably not. How about the 1-hour? Are we doing anything interesting? Well, we tested it. We're back above it. We haven't gained anything back. Price is still coming down. Hasn't quite turned around. How about the 15-minute? Are we creating any kind of like up structure where we're gaining stuff? Not yet. We're getting close to it. Closer. Are we seeing any breakdown of flow? Oh, look, the trend's starting to change on the low 15-minute low time frame. What about the 3-minute? Are we gaining stuff? Yeah. We've actually gained some stuff back. Right? Gaining back some structure, gaining back some levels. What's important now for continuing? We want to see what happens up here. So you're essentially seeing like the low time frame is starting to turn around, and the higher time frames haven't caught up yet. Can you still trade the low time frames? Absolutely. What are you looking for? You're essentially looking for a continuation and the reaction here at the highs, right? You want to see what happens up here. Essentially, this. You want to see what happens there. If you can gain it. Yeah. Yeah, go for it. Yeah. So you can, but you have to make sure you understand where your stop loss and where your essential liquidations and stuff does, how it's affected by you getting back into the trade. That's one. What? I move it up. Yeah. So you're asking like where I move stop losses up and then where I average into positions. So essentially what I'm doing there is if I'm adding to my position, it's not going to be to my take profit because essentially like even here on the 3 minute, right? Um, where did we say we entered? Yeah, there. So that was the initial trade plan that we went to, essentially, targeting somewhere around here. I don't remember, but with a much better risk reward, something like that. It was like 5 to 5 or something like that. I don't remember exactly. But yeah, so essentially what you're trying to do with the structure is that with re-entering your position, it has to be based off of price action. You shouldn't just target your take profits because your take profits have changed. Like essentially the price action has changed. So what you could look for then is basically say, well, we've done the second major profit target, right? If this was our first one or something like that, I don't remember exactly where I placed it. If that's the entry there, and this was our first profit target, where's the obvious second one, right? Where's the third one, the next level, to the 2666 level that we talked about, right? So a lot of times with that, if you want to continue the trade, how do you continue making higher highs? Well, you have to hold structure and levels that continue to go higher. So what I would do, if you have it in like the 3 minute or something like that, you're gaining structure back, which is good. But when price is coming down, you need to have the perspective of, okay, well, are we gaining or are we failing? Are we gaining right now of this, essentially gaining some of this structure back? Not yet. See if we can lock it in. But for me, that's more important is that we've rejected. I would much rather it then come further down. And then we see like on the new stuff that we've created, essentially, right? We've got some new levels now created around here. And then that reaction. If you're scalping on the very low time frames, I wouldn't recommend adding to your positions at all. If you're trading on higher time frames, it has to be based off of the actual structure. Like let's say I'm on like the 1 hour, right? And price goes down, there's a higher low, right? And I get my first entry. Essentially, we test the swing perfectly, I get my first entry. Well, what's the next thing up? We go up, we fail something higher up, but then we create essentially another test. We come back and test structure. Do I enter here? No, I don't do that. Why? Because we can very easily come all the way back down to test, the low that's untested or the high of the swing, right? So what I do is then say, well, that happened. What do I want to see for continuation? Another higher low. So it's completely based, if you're adding to higher time frame positions, which like I said, I don't do low time frame. I just don't believe in it. I think it's too greedy and I get pissed at myself whenever I've done it. It usually it's gone about 50-50. The problem is that you end up wiping out profit that you've made. With the higher time frames, it's entirely based off of price action. It's entirely based off of where the structure is testing, right? If that makes sense. And then, yeah, a lot of people, again, they re-add to their positions, and it's mostly out of greed. They want to make more money in a good trade, but most of the time, by the time that happens, they're saying, oh, I can make more money, and what's happening? That's starting to reverse. We're starting to fail. So my recommendation is definitely what? Yeah. And that's the greedy thing about it, man. A lot of people don't like, they play the game in their head and they do this and they use the scale for the wrong reason. Like the scale is not there to show you, oh, if I would have bought the entry that I showed, I would have made 0.8% in profit, and then I would have, with 20x leverage, I would have made, 16% or whatever, right? That's how people use it, and that's the wrong way to use it. The right way to use the scale is essentially to say, oh, well, we've taken out 50x leverage positions, or we've taken out 100x leverage positions, and yada, yada, yada. What I would say is that your best thing to do is, if you have a very profitable trade that you're itching to essentially re-enter or add to, the best thing you can do in my head is say, hey, I need to reward myself for taking a good position, a good trade. So what do? You exit the position, you look for a new entry. You close out like one of the hardest things that people do, and this is constant, and this comes back to not cutting their losers and not writing their winners. Like if you're winning in a good trade, don't get greedy and then add more to it, which now changes the dynamic of where your entry is, where your stop losses are, and your exposure is. You can do it on higher time frames, but it has to be based off the structure. Most people will essentially, oh, it's underwater right now, but I'll keep holding it until it goes plus because I don't want to lose money. So what does it do? It goes right to your stop loss, right? It goes right to your liquidation level. So my recommendation really is, until you've been able to really, high time frame, be able to add to positions successfully, which is, it's not easy. I'll be honest, it's not an easy thing to do. You should probably avoid it. Most people should. It's like hedging, high time frame. People get freaked out by hedging because it hurts themselves. There was a guy, if you guys remember the FTX leaderboards, there was a dude, John Brown, I think it was. The dude was at one point 400 mil underwater, trying to long I think it was, let me see. I want to say it was like, yeah, he was trying to long essentially this structure here. He's long this structure here and was trying to remain hedged, thinking that was the low. And then it came back against him, and he was like 400 million in debt. And then he came back out and closed at break even because he got a nod from Sam before FTX went down, like a lot of people did. So, like, this high time, like the greatest way to trade higher time frame, if you have the essential like patience for it, is on a high time frame market. And let me just get rid of these. I can leave that, otherwise I'll forget. If you have the high time frame ability to trade in like the market in that sense, let me see if I can find the level. Okay. If you understand the high time frame cycles, what should you be doing at expansions? You should be looking to short expansions. Like the greatest way to trade in my head is short the highs from like the major cycle highs, and then look to build spot at the lows. And then once you start going into the bull run, you're using your spot, your underlying asset. Let's say you have like, maybe you build up a couple of Bitcoin or 0.1 even, like whatever you can get. You look to use that to take your long positions in a bull run. So what that guy was doing, people were shorting back in the blow off, like one of the easiest shorts ever, the blow off when Bitcoin used to trade like a shitcoin because the market cap was still low enough, right? You kept shorting it until you collapse, and then everybody starts trying to long the lows, thinking, oh, this is the floor, and then the floor drops out, and they get stopped out. But what you really do then is you stay hedged. So as you go down, you're taking more profit. You start building and accumulating, building more longs. COVID dumps, everything dumps and nukes off a cliff. We regain floor structure. It's continuation, right? Like I was one of the ones who got stuck here around 10K, not having big enough bags in the last bull run, still looking as like, oh, we're still potentially failing. when what I should have been looking at is the higher time frame gains going into October, when we basically, invalidated the downside and the bull market was on. But that's the whole thing on the cycle, is that if you want to be like a great trader, the idea is to be hedged. And most people don't know how to hedge because it doesn't enter their minds to, short as much as you can at the high, moving your stop loss up, taking some profits as price continues to retrace, and then having that level to say, well, if it goes below this, I want to start accumulating. And like I said, most people don't do that, right? This has been our plan for 2 years. What's the accumulation zone? Anything that breaks under the previous high that goes back down towards essentially, back down towards 10K. And how do you accumulate? A little pyramid. You start dipping your toes in when we get underneath it. Oh, bigger drop down, you get more exposure, more buys. Oh, we start going back up. Do you want to start buying as you go up? No, but you can buy higher lows. And that's exactly how you essentially hedge yourself off using spot. And that's what a lot of people were doing, essentially, is you hedge yourself off in your positions, and you can also use spot as a hedge. You can use options as a hedge. Like a lot of institutions, when they trade, TradFi, they will use options to hedge off positions as kind of an insurance, essentially. And the buzzword is delta neutral on trading positions. Like, you don't even bother yourself with the Greek alphabet regarding trading. It's not important unless you're at that level. But that entire idea is that they'll build spot, essentially. Let's say I have 100 Bitcoin, right? I don't want to sell my Bitcoin in the highs, but how do I protect myself in case it goes higher? Well, I'll hedge and I'll take a short and I'll build shorts above a certain level for the same amount of Bitcoin that I hold. So as price goes down, I'll still retain the value of my Bitcoin as price continues the downside. So I've essentially, the market neutral price of my account is whatever the high was overall, because I'm still holding spot. And if I'm shorting for the same value of my account with what I'm holding as far as like Bitcoin, even though the Bitcoin price drops, I'm in profit all of this downside that we've had, essentially protecting myself from capital loss. And that's essentially how you stay hedged, which is you hold your assets and you only sell off some of the top, and then you start hedging and shorting on the major cycles to to essentially provide for yourself in the bear market. But that's a whole another weird thing that blows most people's brains, and it's a weird concept. And some people, like I said, looking at the high time frame stuff, as far as guys who shorted cycle tops, a lot of them, they sold a lot of spot. You essentially selling off, but how do you protect whatever capital you have? You're not going to. These guys don't ride Bitcoin down to zero or ride shitcoin down to zero. Oh, I have a bag of 4,500 ETH. Am I not going to take profit? Oh, it's my watch thingy. Am I not going to, ETH goes to 4K, 4.6, 4.7. Am I going to sell some ETH? You're damn right I am. But am I going to short and I'm going to dump everything in case it goes higher? No. How do I protect my capital? I take short positions for the same value of the size of my account. Once we break levels we can't lose, that move back to the downside. And this is kind of like the whole, why does the high time frame matter? Look at the high time frame. What have we done? Essentially, you lost the level. You had the high. You swing failed the high back in November of 21. You broke down, created a new low. Everything after that's a failure. You had a major flush out that lost levels. You create that new low. What's your first thought? I want to essentially fail going up. What's the next major level? The floor that we failed at. Swing fail off a cliff. And that's the high time frame play. But most people, even me included, the patience for essentially holding positions open for weeks is not something you learn. That's not something that you can just watch a video and do. It's like something that takes a lot of time to essentially, I'm going to hold a position open and pay, maintenance fees on a position for X amount of time. And it's a weird one, but that's the high time frame play, is essentially to stay hedged in the market, to continue making money and accumulate and make money on my shorts. As price goes down, I'm taking some profit. I'm accumulating and taking that money I make in the bear market to add to spot bags of stuff to go higher. then once we enter the bull market, then I'm looking to actually, start selling off more at the top. And then, yeah. Essentially, I look at it from a risk and loss perspective of everything that I'm trading on the centralized exchange, stuff that is not like in my cold storage, is essentially crypto and capital I'm willing to lose. And that's how you know if you're too exposed to the markets. Because if you cannot, like, you have to understand, like, it could all be wiped out, essentially. If you have money on centralized exchanges, who's it insured by? Some companies like crypto.com have like backing up to 250K for fiat and stuff like that. But most of the guys, it's not your crypto. It's not your money. So even on the position sizes that I have and that people have, when I take my profits, I'm not going to just leave that capital back in the exchange. I'm going to then take it off the exchange. And that's what most people don't do. Like the way to fight the mentality of like you're in constant fear. If you're in constant fear, you're overexposed to the market. That's the best way to explain it, essentially. It's like, what makes you uncomfortable? What makes you sweat? Oh, well, I've got, 2 mil on the market. Would that amount of money change everyone's like life? Like, damn right. That's life-changing money. Are you willing to lose it? If no, maybe pull half of it or 90% of it. Like, the hardest thing for most people also is they don't pay themselves. They put money into crypto and then they don't have off ramps. They don't, take money back out of it. Like my trading paid for a large majority of like my house. And that's only because I took money off the exchange. But most people don't do that. Most people, they say, oh, I just want to keep making it bigger and bigger and bigger and keep growing my capital that I'm trading with, which is good. You still want to, you want to increase your capital because you'll make more money. It's compound. Essentially, it's an exponential growth curve on everything, where if you're trading with more capital over time, it just goes, your returns will increase, exponentially. But most people don't ever pay themselves out. They don't say, hey, I've made, $300. Maybe I'm going to move that into my bank account. That's how I keep myself honest, is I pull money off. I off ramp it entirely. And then, like I said, if I'm nervous about it and like holding positions open for that amount of time, then I'm overexposed and I start closing positions. That's the best way I can explain it. Use your own gut feeling, essentially. Don't be fearful. Don't be like, oh, I'm going to lose everything. I'm going to go live in the poorhouse. Like I had a guy who I knew who was taking loans out to buy Bitcoin in the bull run. He was taking loans out and taking a mortgage out on his house to buy Bitcoin back in, or was it? He was buying Bitcoin here, like back in this structure. Yeah, when we hit 40K. And he was panicking because he lost 25% of the value in like, a couple of days, essentially, like the month of January. And he's like, I think I'm just going to sell everything. It's like, this is stupid. I just lost 25%. And it was not a small amount of money. I said, no, it's a bull run. You continue until proven otherwise. And he did. He got out. He made some profit, but he eventually bailed, of course, before the high, which good on him. But that's the whole point, is that like that type of stuff, like I know a guy who maxed out credit cards to buy, basically Dogecoin, saying like, oh, it's going to this amount of money. And he ended up losing a shit ton of money because he was essentially buying Doge at the highs here, 70, 60 cents, and saying, oh, it's going to $1. It's like, why is it going to $1? It's like, oh, because everyone says it's going to $1. It didn't. Like, at the end of the day, don't ever expose capital. I mean, like, not financial advice, but don't expose your, like, I think it's pretty common sense. Like, you don't ever, put your necessities for life at risk to trade. And if you think that like the money you have in positions is too sweaty, like you're nervous about it, keeps you up at night, you need to de-risk. You need to close positions. You need to expose yourself less. But as far as keeping like that mentality, it's really simple. If you like the shorts that we held for the most part down from Bitcoin, going all the way back to April Q1, Q2 of last year, the Q2 shift that we saw last year around 48K, when we were like, pretty adamant, like, hey guys, start shorting everything. The exchanges are fucking all the Q1 options, right? Like that's like one of the clearest things of market manipulation that we ever saw, which was, exchanges heavily shorting price to push the April Q2 open underneath the Q1, wrecking it, and then holding the high. Essentially, Q1 options get absolutely destroyed. They restrict the price up at the September opens, restrict the price of the weekly SR, and then they fail it under the yearly open. And by the time you did that down leg, it was done. What happened the moment we lost essentially the April Q2 and got back into some of these levels? Stop loss and profit. And I stopped thinking about it, because at that point there's no capital. There's zero risk to my capital. If I'm doing, if my risk to my capital is 2%, right? If I'm risking 2% of my total capital, regardless of leverage, but that's my risk in a position, how do I reduce that risk? You can reduce that risk to zero by moving your stop loss into profit. And it's that simple. But as far as exchanges going down, dude, spread it. Like, you don't have to take all of your positions. I have like 7 or 8 different exchanges that I've used. I think I use like 3 right now mostly, but yeah, I spread it because you never know. Dude, it's so rough. I mean, something that I've seen as well, especially using VPNs with stuff like BitGet. Like, BitGet is still no KYC apparently. It's been working pretty well for me. I was worried. So many people were, and some people, it can essentially, you can do you can create multiple accounts, and the problem is you have to be able to manage it. And if it's too many positions or too many different accounts, like, if it's not manageable, my kind of rule is like, if I get all of my crypto off exchanges in like, 10 or 15 minutes, which is a lot of time, especially if shit's going down. But if I can, then I'm pretty happy with it. And that's, I've set up stuff for that to happen, essentially, where I could just pull all my accounts. I've whitelisted all of like my own personal save, like, safe addresses that aren't tied down by anything. So as long as I'm able to do that, I think I'm pretty happy overall. That's generally my thought process. Yeah, I got one of those. I like SafePal. I love the QR code scanner. Yeah, you can connect it to trade, but it's not like the network that you're on is not like not a centralized exchange network, right? So like, if there's no fear, if it's a decentralized network, like as an example, you have your stuff on ERC20 on Ethereum network. It's a decentralized enough network to where you don't have to worry about your account going down and like the centralized exchange destroying it, essentially, because nobody could do it. The amount of money, if people wanted to try and manipulate the price, like there's a really funny video of a guy explaining, it's like, oh, but can't the governments of the world just band together and build data farms and mines that essentially give them access to the block? And it's like, no, like that comes with an understanding of the blockchain technology from that side. And I have a neighbor who's like a brilliant speaker, and he goes around and teaches about blockchain, and he essentially explained it to me as, yeah, they'd have access to be able to double spend for 10 minutes and that's it. And then they get kicked off the block by everyone else because it would cost them also $1 billion, at least billions of dollars nowadays. Because this was years ago. It would probably cost them like half $1 trillion to build enough mines and nodes to be able to affect major networks like the Bitcoin network or Ethereum, and they can't do it, and they'll be kicked off it. So, there's not a chance of like decentralized networks failing because it's essentially just it exists decentralized. The problem that you have is that if your money's on an exchange, it's not your crypto's not technically your crypto. It's on their address that you have access to. Yeah, I'll pop it in the Fireside library. I just got to figure out how to format and compress it so I can actually put it up there I got to send it to Egil as well so we can upload it correctly. But he's I'll talk to him when he's back. Well, thanks. I'm glad you guys enjoyed it. Yeah, it was yeah. Okay. Yeah. Yeah. Have a good one, buddy. But yeah, I think that's pretty much it for me. Nice little. That was. Yeah. Yeah. No. What's your question? Yeah. No worries. No. 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 No, that's the opposite. The more support and resistance is tested, the weaker it becomes because it builds long and short liquidity in the same spot. An example of this is what happened on the 29th to 31st of May. We had this, everyone's like, oh, look, my triangle, it played out. Well, I thought this is a bull flag and it's supposed to go up here. It's like, that's why triangles are not for trading. Triangles are for identifying liquidity. It's like trend lines, right? So what happens is the reason the long liquid why this broke down eventually is that you have a significant level of lower highs, right? And all of the longs are basically in the same spot. So what does that mean? Like people up here are getting stopped out, and the only people that are safe to build levels are at the same price point. So when those things eventually break, and they don't always break, like it's still reverse, right? That's still possible. But the reason you look at the triangle in the sense of like the flat top and the flat bottom triangles is because you're isolating the fact that, hey, these are longs being created. These are longs. And the more it's tested, eventually it breaks. It goes off a cliff. And that's why, because support and resistance, like I said, it doesn't become stronger over time. It becomes weaker the more it's tested. Yes. Yes, yeah, and the reason for that is it's the effect of the market on price. So the reason it fails essentially is that if all of these longs here, and maybe there's 10 million in contracts of longs that are built up in the same $50 low area, that's all that's left. When you enter the position in the market, what happens to the market? Let's say you take a $10 million value long. The price is going to go up affected by a $10 million up move. When you get stopped out or liquidated, if you're in a 10 million long, how do you exit that position? The only way to exit a position is by shorting the same amount of if you're in the long, the only way to exit the position, the market effect, is you short the same amount of money or value of the trade as you were essentially taking long. And this is why you're losing money. You're essentially buying at a level and then having to sell lower than where you bought. So the market effect of why it drops off a cliff is that, well, if there's 10 million right here at 27.5 and those things get stopped out, what's the market effect? It's a $10 million short. That's the market effect of why it breaks down. Is because when people get stopped out, when people get liquidated, and there's large amounts of capital that does it, that's how you get major liquidations. It's the same thing with pumps. Like, does that make sense? Yeah, cool. But that's essentially the nutshell. Is support and resistance become weaker over time because of that fact. Well, the only thing with that, I would be very careful with using weird hourly candles because the data isn't relevant, because there's no, like, 3 hour isn't super relevant, 2 hour kind of, but not really. Like, the problem with going into like more strange time frames is that you're essentially just getting a bar candle that's not super relevant to overall price action. That's the kind of, yeah. So that, like, I've seen some people will use like 45 minute or like the 7 minute, and I was like, what does that mean? What does that do? Like, what's the data getting you? Like, to me, it's more of like false reads. So I'm more like, I'm very traditional in like the candles of like, use the stuff that works and not overthinking it with like mixed little. No, 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 no. Go ahead. Yeah. The problem is those aren't time frames. Those are randomly put together periods of time. That's the problem, is that they're not standard. Like, essentially with trading, there's more standardized time frames of like what works and what doesn't. The problem with using like these kind of interim time frames, the custom time frames, the data you're getting on it isn't relevant to the overall price action. That's the problem. Like, so you can get a lot of false reads essentially. Because I mean, like, you're not entering trades on like the 3 hour, right? Yeah, yeah. Because the problem is like, with the different time frame stuff, some of these time frames are so arbitrary. It's like, why is a 3 hour period relevant? Like, how is a 3 hour period relevant when essentially you're splitting it up instead of doing the 4 hour period, which is much more relevant, and we know it is because we know how effective 4 hour trading is. That's kind of like the issue I have essentially, is that it it's easy to kind of do that. The problem is that if you're using those kind of inter-time periods, you'll fall into one of the biggest traps, which is confirmation bias, which means you're essentially clicking through stuff and it's telling you the same thing, but it has no value in telling you that it's a good trade or a bad trade, right? It's like why I don't use moving averages, because at the end of the day, if somebody who uses only moving averages doesn't get a moving average that works, oh, well, then it's not the 200 weekly moving average, it's the 32 EMA on the daily or whatever. Like that's the same thing as trend lines. Oh, the trend line is this, it's going to play out. It's like, okay, well, maybe on like a very, very, very high time frame, but on low time frames, like, I couldn't possibly care less about trend lines, only as a visual representation of liquidity. Which is, if we start breaking liquidity, where do we go? We go back to test stuff. That's the whole point, is that the different time frames are essentially just, you're using something like confirmation bias, I think you're better off just sticking to the standard stuff, because those periods of time that show you information aren't relevant like overall to trading. Yeah, it's just my recommendation. If it works for you, like, That's one of the biggest issues is that until you've created a system that's consistent for you, you'll keep looking for new things to try and tell you a way to trade. My best recommendation is really focus on the things that work, and the things that don't work should be ignored entirely. It's always good to experiment. Like I experiment all the time with stuff, but I know for a fact that I'm not bringing new things into my trading strategy anytime soon. That's the big thing there is like get really good at like what your strategy is without trying to step out, because everybody wants that. Everybody wants that little piece of alpha. It's like, oh, but if you use this thing, this indicator, if you use like, this candle pattern thing, like that's the problem I have with that, is that you're constantly going to be evolving your strategy when your focus should be on consistency. If that makes sense. Yeah. Yeah. No worries. Yeah, it's a time-based thing, and like eventually you just learn to ignore everything else because it doesn't really matter. Like one of the biggest problems in the space in general is just misinformation, disinformation. Everyone's got some new, shiny thing, and everybody wants that cool shiny thing because they think they can make money with it. But it's like, do what works, do what makes profit consistently. Don't try to look at things that, oh, you could 2x your money. It's like the people that we get spammed. Like we added a lot of spam blockers now, but like generally we were getting people like every day just saying like, join my WhatsApp group and I'll teach you how to make, $4,500. Yeah. It's like, fuck off. Like that doesn't happen. It's not important. It's the consistency. It's the grind. And if it's boring, then it's probably a good thing because you probably have less emotional attachment to it. Oh, that's cool. Oh yeah, for sure. Again, this is like a joke thing, but essentially, what you look at in this structure, like what happened, right? Well, you created a low, and that's why, like even yesterday, I was like, oh, there's maybe a little bit of a long there. I think yeah. So we're looking at it here. It's like you got a little bit of a long potential, but what do you do before you step off to regain? Well, you break down, you create a new low to grab all of the liquidity, and then you close pretty bullishly with some out of position shorts a little bit, and then you have the next candle, which is just completely in position bullish that takes out all the previous stuff. But essentially, the Bart Simpson is just a liquidity grab. That's all it is. That's why essentially you just go. I can't draw, but it's like the Bart Simpson eyes, right? It is. They don't have noses, do they? Like the weird mouth thing, but yeah. And then you have the spiky head because what are they doing? It's grabbing liquidity and then nukes off a cliff. It's all liquidity grabbing. Yeah. It's essentially what it is. Yeah, because what do you do? I mean, like, why is it important? What does the pattern actually accomplish? Well, you essentially dump or pump to new levels, and then you trap liquidity. You take the last thing you do before you go back up. It's almost, people always also call it the Batman. I've heard that before, you get like the Batman pattern or whatever you want to call it. But it's the same thing, essentially. You create a level where you have people now longing, trying to catch the low. You do one last drive down to take the liquidity of the late longs. Then how do you re-enter? How do you enter at maximum liquidity? It's when other people are getting exited their positions. So if you're trading with like millions of dollars, if you're doing like really high volume stuff, you want to have the liquidity to enter a position fully. That's why, like, if we trade with high stuff, like high level stuff, and I want to make sure I get my entry and not a partial entry, depending on the liquidity of exchange or what I'm trading, sometimes you can tick on what's called FOK, which is fill or kill. So if it doesn't fully fill the order, it kills the order. That way you only get a partial fill, as an example. And a lot of these guys, because they're trading such massive amounts of money, they have to enter at full liquidity. So what happens is they have to take out the longs before doing one last lick grab. They then gains and goes higher, essentially. It's a pretty scammy thing to do, but I mean, they're good at it. But even the big guys lose big money. I mean, like summer of 2021, I was laughing a little kid because there's somebody who got liquidated for like 70 or 80 million on BitMEX. It was so funny. And I could tell you exactly where it was. It was probably, yeah, he literally got he was, this one guy was responsible for this candle. Yeah. Oh yeah, we were watching it live. It was freaking hilarious. Like, he literally got liquidated. This is the drive up. Him getting liquidated because he was shorting the absolute trash out of it. He gets liquidated. Price is driven up like that amount of money. Yeah, there's a lot of other people who got liquidated because they were trying to short this zone. Then you had a rebound of the level. Then you had a bullish back test of the previous structure. Essentially, continuation. And then you've created more basing structure to go higher. And that's what happened. And it just continued and continued and continued. They did a little bit of a distribution. Held the midpoint of the range. Continuation. Then you have the high in Bitcoin. It's like, we'll see this again. Like, this is probably typical for the cycle now, which is massively deviating structure on a high time frame. Extreme deviations that led to a complete blow off. And then once that happened, I was still kind of in disbelief, be like, oh, I can buy 53K. Ooh, maybe we should get out. Ooh, it failed. Done. Gonzo. Like, it was pretty much dead there. It was 100% dead there. No chance of regain. But that's all it is. All right, well, I got a screaming baby in the background. I got to go. Yeah, have a good one, guys. I'll talk to Egil and try to get this thing up as soon as we can. No, thank you guys. It was a fun session. Well, I appreciate that. I'm glad you get some out of it. Yes, sir. So you guys have a good one. I'm gonna bounce. You guys are welcome to chill, like hang out in here anytime. So you guys have a good one. See ya.